Hello, everyone. Welcome to another webinar by Smartkarma. I'm Michael Tegos. Our webinar today is organized in collaboration with the Singapore Exchange, and it's the third session in Insight Provider Kyle Rudden's series on ESG investing. That's environmental, social, and governance. I have the pleasure of welcoming back Kyle, who will tackle the thorny topic of ESG Alpha today, which, as you can see from the title, you kind of know what you're in for. Kyle, welcome back to the webinar. I'm sure this is one issue that people would love to get some clarity on, so let's get right to it.
Well, I hope they get it from me. Thank you, and good evening, everyone. Thanks for your interest. As Michael said, today's webinar is the third in a series on ESG-related issues in investing and finance, and as he also alluded to, this is arguably one of the most important subjects. I mean, we're talking about ESG and ESG Alpha today. I'll do a really quick introduction because it is a complicated issue and there's a lot of content to cover. So make this one short. I've been covering ESG at Smartkarma since 2019 sometime, but for about 12 years. Independent ESG investment research. I did some index creation. So kind of been around the block on the ESG side. And before that, I was in more traditional research. I headed up JP Morgan's Global Energy Research Group. Covered a lot of ESG issues then. Renewable technology, pollution control, et cetera, but we didn't call it ESG. So today, we'll talk about ESG Alpha. We already got the introduction done, so that's good. These webinars in general, and this one too, I try to generally structure in three sections if I can, content. This one was a little tricky to do that, most of them I can progress, from section 1, 2 to 3, and everything kind of builds upon each other. This is going to be a little bit more circular. You'll see what I mean as we get through it. The first section I'll do pretty quickly, really just providing a backdrop, kind of how we got where we are and why the subject of ESG Alpha is so complicated and also contentious at times. Focus the most of the time on the rest of it. The second category, problems in the problem solution sense. I mean, they're not real problems, but they're issues inherent in ESG and ESG data and products, et cetera, and so forth, that make ESG Alpha a complicated issue. So that's kind of the negative, the devil's advocate first, and then we'll get into some of the more positive stuff. I would purport that ESG Alpha does or can exist. You have to look for it in order to find it, and that's kind of what that third section is going to be about. First, the backdrop. Kind of the mainstreaming of ESG, as it's called, going from, I'm going to begin by mainstream, is kind of going from what was not too long ago a really niche investing sector, and it was not too long ago far more closely associated with, socially responsible investing, ethical investing, et cetera, and so forth. I mean, now it's gone mainstream or more mainstream. It's still about conscientious investing, but it's more of a general interest investing framework that's been adopted around the world. I mean, so mainstreaming means a lot of things. There are kind of three aspects to this backdrop. One is growth and just growth in ESG and growth in ESG assets under management. And we've gone from close to nothing 10 years ago globally to, I think the latest number is 35.3 billion. It's 55% over 5 years. And continues to grow. I rounded the number. I expected to be about 50 trillion in 2025. It's kind of a round number. That's Bloomberg's estimates. That's GSIA's estimate. All kind of average, but ballpark. 50 trillion. It's a big number. Another issue, and that's really just kind of putting things in context. There are alpha implications. I mean, it does get harder to generate alpha when there are more investors chasing the same things. We've seen massive inflows over the last few years into ESG in general, but ESG assets can mean a lot of things. One thing that's particularly relevant is strategies. Just over the last few years, we've seen a pretty pronounced shift, at least as far as funds go, like mutual funds and ETFs. Sorry, exchange traded funds. Well, I'm talking about private equity funds or anything like that. You see this significant shift from active to passive. I mean, it's still mostly active. We're talking about like 330 or so billion in exchange traded investable funds. It's about 60% active, 40% passive or indexed now, but that keeps changing. I think it was 3 years ago, it was 19% passive. So we went from 19% passive to 40% passive in just 3 years. And all indications that's continuing. I mean, we had about 55 billion or so in ESG fund inflows last quarter, third quarter. That was almost all, I mean, not 100%, but almost all into passive. So, that's a pretty critical trend. Again, it gets harder to generate alpha, make active stock selections. The last thing, which is probably of these three, in terms of the context of this presentation, probably the most important. It really gets to the crux of this section, and it leads into the next. It's just the very different investor base. I hate to use the term ESG investing these days because it means so many different things, and that has some connotations from its legacy meanings. And I'm careful to say ESG investors. They often say ESG related because they're varied. But the point here is that the mainstream of ESG has really dramatically changed the demographics. We have more investors, certainly. We have more investors in more places in the world. It was Europe and the US not too long ago, and now ESG is truly global. So more investors, but also very different investors, mainstream investors. We're not talking about the socially responsible investors or ethical investors as defined several years ago. We're talking about fairly mainstream investors. They run the gamut. Certainly, again, socially responsible minded, since we have a lot of millennials, but impact in the traditional socially responsible investing sense isn't the primary motivator. It's still a motivator, but we're definitely seeing, an alpha first group, kind of alpha first, impact second. If you think of everything up until fairly recently as ESG 1.0, that was more about beta and risk management, and ESG 2.0 is about a lot of things, but chasing alpha is definitely one of them. Problems, not really problems, complications. But again, these problems, because we're talking problem solution in this. That was the backdrop. The mainstream of ESG. It's a wonderful thing. 10 years ago, I couldn't get anyone to listen about ESG. How happy they are. But as wonderful as it is, double-edged sword, because the mainstreaming, in many respects, is the root of, call it the ESG alpha problem or conundrum. Not the mainstream per se, that isn't the problem, but it's that the mainstreaming and this big group of new investors is kind of created and continues to feed a demand for ESG data and ESG investment products that do cause problems, and we'll get into those in a little bit. I put this in there. I think most people know what we're talking about, but I want to put this in there because the term alpha or ESG alpha, the phrase, is thrown around pretty loosely, and often it's not alpha they're talking about. It's something else. It's outperformance of an index, or using simple returns or something else that isn't really alpha, but use the term interchangeably. I talk about like the press and new and slightly naive investors, but one example that kind of that, and I think it's important to lay out. It's an example of a generic kind of category of an issue, but I'm putting one specific one in here. Is all these proofs of, quote unquote, proofs of ESG alpha that really aren't. The most common one I know you've seen is chart-based evidence, quote unquote evidence, and I'm sure you've seen it. I know you recognize it. You call it whatever you want. You call it false alpha or proxies for alpha. Basically stuff masquerading as alpha that isn't. And again, mainly talking about chart-based quote unquote evidence. Where someone plots such and such an ESG index against such and such a broad market index. Looks at which one is higher at the end and claims proof, and then the headlines run with it, et cetera, and so forth. There's a place for that kind of stuff. I mean, I understand that not everyone's kind of claiming it's alpha. You need to keep things simple for certain kind of publications, et cetera, and so forth. But it does become a problem when claims are too significant. Sometimes even approaches the greenwashing level. I mean, sometimes it's just confusion that it's not alpha. But sometimes it's spin and it's just not right. But a big one that's sort of representative was last year in 2020, kind of for the year, but kind of second, third quarter, ESG indexes across the board, not highly nuanced or specific ones, but big broad indexes by any of them, FTSE, MSCI, et cetera, and so forth, really outperformed. And it was pretty quickly figured out that a big portion of that outperformance was due to overweighting in FANG. I mean, that gets the headlines, but really just tech. It was underweighting in sectors that didn't do well, and excessive overweighting in some of the sectors that did, in particular FANG. And this case study, or this example, illustrates a number of things that all kind of pertain to the ESG Alpha issue, and we'll get into some other ones. But biases in the sector, just inherent biases, size and sector being two that are relevant to this example. I mean, where regional biases are another one. We'll get to that in a bit, but the space, ESG space, has, for various reasons, sector and size biases, leaning large cap in terms of size, and biased in terms of certain sectors and not others. Tends to avoid or underweight as much as it can in things like energy and certain industrials, right? They're polluted carbon producers, and overweight in others. And tech's a good example. It's a sector that tends to score. I'm kind of talking about the second line item there, issues with ESG scores. Tech companies tend to score really well on ESG for a number of reasons. I mean, some of them are good, but many of them, because this quirk in much of their emissions are not scope 1, right? They're not direct emissions, they're scope 3. And we're getting better at reporting scope 3, but for so long that their emissions numbers were low as reported because they're reporting scope 1. It's just a lot of reasons that tech companies look better than they really are on an ESG standpoint. So you get all these indices and products that are avoiding energy, industrials, and kind of overweighting in tech, and that came to a head in 2022. There are other issues. It's just about construction. There's so many different indices out there and methods of assessing ESG, and then determining whether someone based upon those assessments is a potential candidate or constituent. And they're just all over the place because there are so many of them. It's not that they're schizophrenic or anything, but they're all over the place, and you can get some real surprise, tilts and weightings. I think what we saw in 2020 was kind of a combination of that. And again, that I said it before. I said perhaps greenwashing. The issue becomes when, for some reason, something that isn't really alpha, like FANG 2020, is billed as that. As look here, it's proof. ESG does outperform, et cetera, and so forth. I'm not saying that there was rampant greenwashing about that, but we need to be careful about being clear that outperformance is great, and it's ESG related outperformance. I'm not knocking it, but we need to be careful about claiming that the ESG factors are what generated the outperformance. That's really a central theme in all the academic research about ESG Alpha is the issue whether or not it's ESG factors, they're quality factors, other quality factors that aren't necessarily ESG related. There's a great study. There's two of them actually. One's by Scientific Data, which is kind of the devil's advocate things, but it was really well done. The findings there were basically that ESG doesn't, on the whole, outperform. There were some findings where it did. It does provide downside risk, and that's been the case in the past. About beta and risk management. That's where it's strongest. It felt that a lot of the alpha we've seen over the last few years, potentially that FANG run too, is simply because of the mainstream of ESG and all the inflows. But there was another study. It was done by NYU Stern School of Business. It was a meta study. It basically studied all the other studies. It was a little bit more positive. The gist of it was, out of a couple hundred studies that they looked through and analyzed, 55% of the meta studies were finding ESG alpha, and 45% weren't. So it's slightly in favor of, yes, ESG alpha exists, but not definitively. The where ESG alpha can be found, one of the most critical things is that for real ESG alpha to exist, it needs to be very, very case specific, and that's part of the problem. Is that there's been such a proliferation of ESG scores, ratings, rankings, indices, and there's nothing wrong with those. Like MSCI and Refinitiv and FTSE, they're great what they do. But it's impossible for any firm to really cater well to such a mass of investors and different needs and portfolios that it's hard to generate with certainly passive investing and with a lot of these third-party products, it truly needs to be case specific. And we're talking about individual portfolios, individual securities. We're talking about regional differences. Regional's big. There have always been regional biases. I think that's changing in terms of coverage, and that kind of goes into the argument that it needs to be active. I mean, you really need to look for opportunities. As ESG grows even more prevalent, it's harder and harder to generate alpha. You really need to combine, traditional fundamental financial research with sustainability and ESG research through an active management process. To find unique insights. I mean, there's so many investors out there all working off the same third-party data. Not everybody, but a lot working off the same third-party data. It's hard to get an ESG edge like it was a lot easier a couple of years ago. And you really need to look in different places. Materiality is important. Discriminating between material and immaterial ESG issues can really purify or make a lot clearer the alpha signals. I can't stress that enough. And another important thing is just finding relative differences at this point. Picking out companies in each sector that are substantially better or worse than others. Kind of the best-in-class approach, or improving. And that's another really important aspect, because ESG data still is kind of static and backwards looking. We the space, the industry, including third-party product providers like MSCI and others. We get the data from issuers, from companies, somehow, eventually. That's still kind of spotty. It's still it's not regulated. All that's changing. So you kind of never know what you're going to get. It is usually a positive spin, not greenwashing necessarily, but it was a positive, or green hushing. Kind of hiding what you don't want people to see. So just even the source data is tricky, and it's not updated very regularly. To get an edge, so everybody's working on the same data for a year until an update comes out, and MSCI does crunches some numbers and produces some slightly better data from it. So you need to look hard, which is why alternative data is talked about a lot in the ESG Alpha conversation. It's not necessarily that it needs to be alternative data, but that's where you can find information, data, if you process it well enough, ESG intelligence that others don't have. It's really one of the most up and coming and important aspects of the ESG Alpha conversation, because it's been called the ESG data problem, and the ESG sector still does have a pretty massive data problem, which is one of the roots of this ESG Alpha conversation.
Kyle, do you think that perhaps it's just too soon to be able to tell for sure what outperformance on ESG looks like? It seems like a lot of the, debate there is that we have seen outperformance since the financial crisis, basically. And I guess that's where a lot of people point at when they say that it's not a good enough time frame to make any sort of judgment calls. So what's your view on that?
There are so many moving parts. I mean, ESG, I'll get to your question about too soon or not, but ESG data, just in general, is fundamentally different, right? It's non-financial information, it's financial implications, but it's fundamentally different, and it's subject to interpretation. Taxonomies are again getting better. Asia's working on something, but even just definitions. I mean, to agree on what sustainable investing is, you could ask 10 people, you get 10 different answers. It's very different to begin with. It's easier. I've been doing this for a while. For years, I was up to my eyeballs in really strong correlations, but always chasing causation. It's fairly easy to connect certain ESG metrics or performance or actions to some economic outcome within a corporation. But as you go down the line and try to get closer and closer and closer to risk-adjusted shareholder returns or bond spreads or whatever, it gets lost. It's really hard to draw the connection, the direct connection. So I guess that's one issue, and that's probably what underlies one of the most common counter argument. It's not counter. It's a counter argument used by the naysayers or by the very objective researchers, that it's often difficult to distinguish between kind of ESG factor inclusion, integration, et cetera, and so forth, and something else that's existed all the time, quality, right? I mean, so much of ESG, and again, I've been doing this 12 years, and I remember years ago, strong governance performance was always correlated with, strong stock performance, right? But that just kind of makes sense. It really isn't an ESG thing. It's quality management thing. And so many of the ESG factors are a lot like that it could ultimately be argued that, it isn't the ESG factor that's generating the alpha. It's an ESG factor that's correlated with other things that, quality management is going to really manage their ESG performance and their ESG messaging and everything really well. So they'll score well, and then the stock performs well. Is the stock performing well because of the good ESG scores, or is a quality management, really doing well on the ESG front? It's kind of a chicken or the egg thing. So I don't know that I can't answer the question whether it's too early, and I don't know that that's the question. Is it too early? I think that it's pretty clear to me, just anecdotally over 12 years, and there's a lot of evidence out there that there's some connection, that there's some kind of ESG alpha is real, but it's ESG, in my view, and I hate to say this because it's, my career is ESG, but it really isn't all that different in many respects to fundamental research we all did 10, 15 years ago, assuming we're old enough, where you kind of went and you kick the tires, you talk to management, et cetera, and so forth. So much of ESG is like that. So I don't know that it's too early, but I think it's too different, if you will. Now, I think the ESG health is there. It's just really hard to extract from correlation some evidence of causality and say that's ESG alpha.
Understood. Thank you. You spoke in previous sessions about the different sustainability and ESG indices that we see. And I guess until those are perhaps a bit more standardized, there will continue to be some, I guess, confusion in the market and different benchmarks and different standards by which we judge outperformance. Would that be accurate?
I think as far as the indexes go, for the most part, any confusion is just because there are so many of them. The big agencies are indexing firms are trying to keep up with a massive growing market demand for different things, different angles, different tilts, et cetera, and so forth, different screens. So there's nothing inherently wrong necessarily with the indexes. It's just that there are so many of them. But there are still issues with ESG data in general. I'm not saying any one particular firm's ESG data. If anything, the third parties improve upon issuer data. But ESG data goes into ESG assessments, which for most of these indices play a role somehow, that'd be by creating a eligible universe or screening them in or out or whatever. So I think the confusion and the imperfection is a little bit deeper. It's the data that feeds up into these things, but there's nothing wrong with the indices themselves other than that there are just so many of them. It's hard, it's hard to keep track. And for, the average retail investor that's looking to invest in mutual funds or ETFs, I mean, you really need to dig into some of the methodologies to understand why you might wind up with a portfolio you didn't expect, right? You often hear about, article that says, why is such and such energy company in the ESG index? Well, you have to look at the index. First of all, some of them will own energy, and they just might be owning the best energy or avoiding the worst energy companies. Or it could be a thematic index that, is a carbon capture related index, and if it were a carbon capture related index, there'd be a reasons to own Sinopec and Equinor and others. I mean, that there are plenty of big energy companies that a prototypical ESG fund wouldn't own, but a thematic one might. These are utilities or industrials or other big polluters that are either developing carbon capture technology themselves or or using it from others, buying it from others to better their footprint. So that, I'm just getting back to that point about how people are often surprised by what shows up in an ESG fund. But if you look at, assuming it's a passive fund index, if you look at the index and understand it, it tends to make a little bit more sense. And a lot of what happened with FANG in 2020 was kind of, it really depends on the index and fund, but less about something that really went out and overweighted FANG. It was drastic underweighting in bad sectors, energy, certain utilities, certain industrials, that kind of created an overweighting in others. So it's just a matter of really digging in and understanding them.
Got it. Thank you very much. A question from the audience touches on the issue of, I guess I would call it the measurability of ESG. And you've touched upon that in previous sessions, but let me read out the question. Can ESG really be measured in a finite way, or is it more of a gut feel indication that it has been done right? Will this mean that we are not there yet if we're not able to measure it properly? If you were forced to list 3 key parameters which are measurable, what would they be?
Yeah, so I kind of the first parts of the question. Yeah, I think I agree with what I think the person is thinking. I think I may have alluded to a couple times here and there that I don't remember exactly what the question is, but I don't want to say impossible. We're talking about ESG Alpha to measure. Eventually, we'll figure it out. But I think right now it's really difficult. It is more, it's anecdotal. It's just based upon being around it a lot and just knowing that there's a connection. There's definitely a connection, and I'm talking about at the corporate level. There's a connection from ESG performance to business performance to economic results of the company, et cetera, and so forth. But ESG is so kind of far down the line from certain parts of the company, from the ripple effects in capital markets, that it gets lost. It's like that game of telephone. At some point, you can't tie the ESG action, way down at some power plant at some subsidiary to what the stock market's doing. And I think it'll be a while before we can do that, if we ever can. And one other thing I would say, I think it'll be easier, or it'll come sooner for certain metrics or certain kinds of metrics than others, which is sort of getting to the last part of the question. I guess my smart aleck answer to that would be, it depends on sector and company because of that materiality issue I mentioned earlier. All right, so it's not going to be the same one or the same 4 metrics or the same however many metrics for each sector or industry or region. It's highly variable. Carbon emissions aren't that big a deal for some kind of financial services firm or a consultant firm, but they are a big deal for industrials and utilities, so on and so forth. That's just the classic example. There are others where metrics are highly material for company A and not material at all for company B. And then investor A will think it's material and it's not material for those companies. I mean, materiality is really a case specific basis. So that's kind of the blanket comment, but there are metrics that are maybe not 100% universally material and relevant, but pretty damn close to that. I mean, any kind of emissions metrics are important. There are variations. It's absolute. There's relative, intensity ratios. Looking at performance over time is important, and looking prospectively is important. The most solid evidence and kind of consistent evidence for ESG Alpha out there always comes back to some sort of concept of momentum and improvement, either momentum in scores or improvements in key ESG ratios. And that again gets back to actively researching and active management and alternative sources of data, because again, ESG is static. It's not updated regularly. And often what happens is you get a fund or an index that's doing a negative screen or a best-in-class screen. You might get companies that don't score well when that assessment's made, because that data is fairly static. It's not the rater's fault. It's the fact that companies don't put data out all that regularly. So you're dealing with data that's a snapshot at a point in time that isn't today. It was probably months ago, if not a year ago. And that company that rated or ranked poorly, that didn't get put into an index or didn't get purchased by an investor, is actually making dramatic improvements. Whereas a company that scored okay and made the cut, might not be doing much in the way of improving or even falling back. I mean, they're just a lot of different potential combinations, but finding the alpha and finding metrics that are important really do need to be done on a case by case basis. Emissions, some measure of emissions on top of the list of potentially universal. If I had to list four, governance, it's still king. Some metric that captures, since we're talking about like picking four metrics, some metric that does a good job at capturing and being a proxy for overall management quality. I don't know that one metric does that, and again, the ones that do are probably going to do it on a negative basis or on a like a risk management basis. Incidents of non-compliance with something, employee health and safety, environmental regulations, anti-bribery, corruption, that kind of thing. But a metric for a given sector, a governance metric that's material for a given sector and that does a good job at serving as a proxy for management quality. Because ultimately, quality of management and honesty and taking this ESG stuff seriously and following through, et cetera, and so forth, is what's going to make or break alpha for a given company. I would rather own or be associated with or do business with a company that's got a terrible carbon footprint, but a honest management with real integrity and a real plan to reduce it and improve things, than a company that just happens to have an okay carbon footprint because of their sector or business or legacy assets or whatever, but really doesn't give a damn about these things. Management's key.
So the G in ESG, basically.
Yeah, well, the G that then affects the S and the E and everything else, but yeah.
Understood. Well, thank you very much, Kyle. If there are no more questions, we can wrap it up. Thank you all for attending. And of course, thank you to SGX for collaborating on this webinar. If you wish to engage Kyle for bespoke research requests, you can contact your Smartkarma account manager and they will help you out in this regard. And of course, I do recommend following Kyle's profile on Smartkarma so that you don't miss any of his insights and coverage. We will have a link to the previous sessions in this series on the registration page as well. And for any other questions or comments, you can email us at research@smartkarma.com. Kyle, thank you very much once again.
Yeah, thank you, everybody.